Welcome to StockTok's deep dive into General Motors. General Motors is one of the largest automobile manufacturers in the world, designing, building and selling vehicles and related financial services across global markets. At the time of recording, the stock is trading at 81.32, sitting in the upper half of its 52-week range, which spans from 43.77 on the low end to 87.62 at the high. The 50-day moving average stands at 77.21, well above the 200-day moving average of 68.74, a technically constructive setup, though the RSI of 63.7 suggests the stock is approaching the upper boundary of neutral territory. Let's work through the fundamentals, scene by scene, starting with a quick business overview. General Motors generates revenue primarily through the design and sale of vehicles across its Chevrolet, GMC, Buick, and Cadillac brands, supplemented by its captive financing arm, GM Financial, which provides auto loans and leasing services. The StockTok score for General Motors comes in at 32 out of 100, a signal our model categorizes as a void. Breaking that down, Valuation scores 6 out of 20, Financial Health 6 out of 20, Profitability just 1 out of 20, Growth 11 out of 20, and Smart Money 8 out of 20. Across nearly every dimension, the data warrants careful scrutiny. Now, valuation. The question every investor has to answer: are you paying the right price? General Motors currently trades at a trailing price-to-earnings ratio, that is, the stock price divided by the last 12 months of reported earnings, of 25.49 times. On the surface, that does not scream expensive for an industrial name. However, the PEG ratio, which adjusts the price-to-earnings multiple for growth, with a reading below 1 generally considered attractive, sits at 1.98, suggesting the market is not offering a significant growth discount here. The EV to EBITDA multiple, enterprise value relative to earnings before interest, taxes, depreciation and amortization, a capital structure neutral valuation lens, comes in at 9.56 times, which is broadly in line with legacy auto peers but offers little margin of safety. Speaking of margin of safety, the Guru Focus Value, an independent intrinsic value estimate, stands at 62.04 at the time of recording, while the stock trades at 81.32, implying a premium of over 31% above that fair value estimate. In our view, that is a meaningful overpayment relative to intrinsic value as modeled. On the economic moat front, General Motors competes in a highly commoditized industry where pricing power is structurally limited and switching costs for consumers are low. The data suggests the moat is narrow at best. Wall Street analysts at the time of recording have a consensus mean price target of 94, based on 26 analysts, with a range spanning 57 on the low end to 122 on the high end. A buy consensus, though the dispersion is notable. The next earnings report is due April 28 of 2026, with the street expecting earnings per share of approximately 2.63, ranging from 2.22 to 3.10, a near-term catalyst worth watching closely. Market sentiment around General Motors, as of the creation of this video, is effectively neutral, with insufficient recent news flow to shift the needle in either direction. In our view, the valuation setup looks stretched relative to the intrinsic value model, even as the forward price-to-earnings of 6.62 times implies the market is pricing in a meaningful earnings recovery. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist that scores a company across profitability signals, leverage trends, and operating efficiency, comes in at 5 out of 9 for General Motors. That is a middling result, neither flagging acute distress nor suggesting robust fundamental momentum. The more sobering reading is the Altman Z-score, a multi-factor model originally designed to assess corporate bankruptcy risk, which registers at 1.23. Any reading below 1.81 is considered to be in the distress zone, meaning the model places General Motors in territory that warrants serious credit risk attention. The cash-to-debt ratio of 0.21 means the company holds only about 21 cents of cash for every dollar of total debt, a thin liquidity cushion relative to the leverage on the balance sheet. Debt to equity stands at 2.15, meaning the company carries more than twice as much debt as shareholder equity, a capital structure typical for auto manufacturers given their capital-intensive business model, but it leaves limited financial flexibility. Interest coverage of 4.01 times, that is, operating earnings cover interest expense roughly 4 times over, provides a modest but not comfortable buffer. The current ratio of 1.17, meaning current assets modestly exceed current liabilities, is acceptable but leaves little room for error. In our opinion, the balance sheet is a genuine constraint on the General Motors investment thesis, and the Altman Z-score reading in particular warrants caution. Next up, profitability. Is this business actually making money efficiently? This is where the General Motors story becomes particularly difficult to defend. Return on invested capital. The return the company generates on all invested capital, and the single most important profitability metric for a capital-intensive manufacturer, comes in at just 1.23%. For context, a business with a strong competitive position would typically be expected to generate return on invested capital well above its cost of capital, which for a company carrying this level of debt would be estimated in the high single digits at minimum. A return on invested capital of 1.23% suggests General Motors is, at the margin, destroying economic value. Moving down the margin stack, gross margin revenue minus the direct cost of building the vehicles is 6.27%, an exceptionally thin number that reflects the commoditized nature of automotive manufacturing, intense global competition, and persistent input cost pressures. Operating margin, which layers in overhead and administrative costs, compresses further to 1.57%. Net margin, the bottom line after all costs including interest and taxes, is 1.46%. Free cash flow margin, how much of every revenue dollar converts to actual cash available for shareholders or reinvestment, is an anemic 0.96%. Meaning the company generates less than 1 cent of free cash for every dollar of sales. In our view, a profitability score of 1 out of 20 in our model is not arbitrary. It reflects a business where margins are structurally thin, and the return on capital framework is broken at current levels. On to growth. Is this business expanding, and at what rate? General Motors shows a more constructive picture on the top-line growth side, though context is essential. Revenue growth over the trailing 3 years has averaged 5.7% annually, a modest but respectable pace for a company operating in a mature, cyclical industry. Extending the lens to 5 years, revenue growth accelerates to 19.2% on a cumulative basis, which reflects both organic volume recovery and pricing tailwinds following the supply disruptions and vehicle shortages that reshaped the auto market during that period. Book value growth, the expansion in net assets per share, a proxy for how effectively management is compounding shareholder equity, has grown 11.8% over the trailing 3 years, which is the most encouraging growth data point in this analysis, and suggests the balance sheet is at least building equity even if margins remain thin. The dividend yield stands at 0.77%, a negligible income contribution that, given the free cash flow margin of under 1%, the data suggests is about as generous as the business can sustain at present. The growth picture here is a tale of two realities. Headline revenue is moving in the right direction, and book value is building at a reasonable clip. But when growth is occurring at razor-thin margins and is not translating into meaningful free cash flow generation, the quality of that growth becomes questionable in our view. We would want to see margin expansion accompany any sustained revenue growth narrative before upgrading the growth assessment meaningfully. Now let's talk smart money. What institutional capital is actually doing with this name? General Motors is held by 19 top-tier guru investors tracked in our database, a meaningful number that indicates the stock is not being ignored by sophisticated long-duration capital. However, the directional signals from those holders deserve close attention. Greenhaven Associates, which carries General Motors as a 15.37% position in its portfolio, its single largest or near largest holding, has been reducing its stake by 17.48%. That is a material trim from a concentrated holder, and it warrants attention. Harry Byrne at Sound Shore Management has cut the position by 28.31%, the largest reduction in percentage terms among the top holders. Samantha McLemore at Patient Capital Management has similarly reduced by 17.96%, and Bill Nigrin at Oakmark Funds, one of the most respected value-oriented fund managers in the business, has trimmed by 17.31%. The lone exception is Francis Chu at Chu Associates, who has held the position flat with no change. Stepping back to the broader institutional picture, only 8.4% of 13F filers, that is, institutional managers required to report their holdings to regulators, are net buyers of General Motors at the time of recording. In institutional analysis, a reading above 50% would signal broad-based institutional accumulation. 8.4% suggests the overwhelming majority of professional money managers are either holding or selling. Insider ownership stands at just 0.49%, a very low figure indicating management has minimal financial alignment with outside shareholders. And in the last 3 months, insiders registered 0 purchases and 1 sale. Smart Money, in our reading of the data, is cautiously stepping back from this name. And finally, the verdict. Let's bring it all together. On valuation, the stock is trading at a 31% premium to the Guru Focus intrinsic value estimate, with a PEG ratio approaching 2. In our view, the price is not reflecting a margin of safety for a business with this risk profile. On financial strength, the Altman Z-score sitting in the distress zone and a cash-to-debt ratio of 0.21 paint a picture of a balance sheet under meaningful strain. On profitability, return on invested capital of 1.23% and a free cash flow margin below 1% suggests the business is not efficiently converting capital into returns. This is the most structurally concerning dimension of the thesis. On growth, 5-year revenue growth of 19.2% and book value compounding of 11.8% over 3 years are genuine positives. But growth without margin expansion is a limited thesis. On smart money, multiple respected long-duration fund managers are actively reducing exposure, insider ownership is negligible, and institutional buying interest is concentrated in just 8.4% of 13F filers. The directional signal is cautious at best. The overall setup, based on what we see in the publicly available data, warrants caution in our opinion. The GF score of 80 out of 100 indicates the business has some underlying quality, and the Wall Street consensus target of 94 implies upside, but the risk-adjusted picture looks challenged. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on General Motors. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.